Welcome to The Explainer. Today, we're digging into a financial strategy that you've probably seen making the rounds online, mostly because it makes a promise that is, well, almost impossible to ignore. And this right here is the incredible claim at the very heart of velocity banking. It's a strategy that's gaining just massive traction, all based on the idea that you can wipe out the biggest debt you'll ever have in a fraction of the time. But the real question is, does it actually hold up? And if you ask the people who are pushing this method, the influencers and the advocates, they are absolutely certain it works. They are adamant that this is the secret to getting your financial freedom back, and in record time. So let's just start there. Let's dive into that promise. What is the sales pitch for velocity banking that's got so many people so excited? And you can see why it's so seductive, right? It's not just one thing. It's this whole package deal. Pay off your house super fast, save a ton of money on interest, and get more control over your own cash. It's really framed as this ultimate financial hack that, the banks don't want you to find out about.
So that's the promise, and it's a powerful one. Now let's pop the hood and look at the actual blueprint. How is this all supposed to work, step by step?
Okay, the entire strategy is built around one single financial tool, the home equity line of credit, or HELOC. Think of it like a giant credit card that's secured by your house. The key feature, the one that's supposed to be the magic ingredient, is how it calculates interest. It's simple interest based on the average daily balance, which is different from your mortgage. So the process follows this specific, repeating cycle. First, you do what's called a chunk attack. You borrow a big chunk from your HELOC and throw it right at your mortgage principal. Second, you park your paycheck. Your entire income gets deposited straight into the HELOC to knock that balance down fast. And third, you pay all your bills from that same HELOC. Then you just do it all over again. It definitely sounds clever, all this shuffling money around. But this brings us to the most critical part, the mathematical showdown. Does all this complexity actually save you any money compared to just, a simpler way? Right. So the central argument from proponents is that you're outsmarting the system. You're swapping out that front-loaded mortgage interest for the simple interest of a HELOC. But critics say, hang on, that's a total misdirection. The type of interest calculation isn't what really moves the needle. It's the interest rate. And borrowing money at a higher rate to pay off a debt with a lower rate, that's almost never a good idea. So let's put it to the test. We'll run the numbers with a $400,000 mortgage, and let's say the homeowner has an extra $1,599 a month they can use to attack their debt. By keeping that extra cash flow the same in every scenario, we can really see which strategy is the one that's actually faster and cheaper. And the results? Well, they're pretty eye-opening. The simple method, just sending that extra cash straight to your mortgage, pays off the loan in just over 11 and a half years. Now look at velocity banking. Even in a fantasy best-case scenario with a super low HELOC rate, it's slower, and it costs you an extra $12,000. In the typical case, where the HELOC rate is higher, it costs you a staggering $39,000 more. This chart just makes it painfully clear. The simple payment method is our baseline, so zero extra cost. But you can see that in both the best and typical scenarios for velocity banking, you don't save money, you lose it. Thousands of dollars more. All that complexity isn't a benefit, it's actually a financial drag. But, the problems here go way beyond just the flat math. This strategy also brings in some really significant hidden dangers. You're basically trading the stability of a fixed mortgage for the wild volatility of a credit line. For one, you've got variable rate shock. If interest rates go up, your whole plan is toast. The bank is in control, they can freeze your HELOC, reduce it, or even demand payment, especially if the economy gets shaky. You're also walking this incredibly fine discipline tightrope. One little misstep and the whole thing can flip into a nasty debt trap. And let's not forget the massive opportunity cost. Every single dollar you pour into paying off a low-interest mortgage is a dollar that you're not investing for your future. So, after breaking all this down, the promise, the mechanics, the math, and the risks, what's the final verdict? What should a smart homeowner actually do? Well, the financial analysis really boils it down to this. It's a high-risk, way too complex strategy, and the benefits it claims to have, they're pretty much a mirage. It's not some kind of mathematical cheat code. It's just a really complicated commitment device. So let's just give an honest opinion. Based on everything we've seen, does velocity banking really work? The data says no. The method itself is flawed. Any success stories you hear come from one thing and one thing only: applying a lot of extra money to the debt. The strategy itself is just riskier and more expensive than the simple way.
But here's the good news. You can still get the main benefit, paying your mortgage off fast, without taking on all that risk. And it's a much better way. First, track your finances so you know exactly how much extra cash you have. Second, automate extra payments to go directly to your mortgage principal every single month. And third, anytime you get extra cash, like a bonus, throw it at the principal. It's simple, it's safe, and as we saw, it's just plain better mathematically. And that really leaves us with one final and, I think, pretty important thought. The urge to be completely debt-free is a powerful one, for sure. But it's worth asking yourself, is the real goal to be debt-free, or is it to be financially stronger? Because as this whole thing shows, those two goals, they're not always the same thing.